Welcome to another special edition of your weekly market update. This week is a big news week for inflation data as well as the Fed meeting that is actually occurring as we speak. So first, though, I'd like to dive into the Bureau of Labor Statistics jobs report that came out Friday and that was very market moving. So let's go ahead and dive into that. As you can see here, the headline came in well above estimates, almost 90,000 increase. 90,000 over estimates, excuse me, came in at 272. As you can see, the birth death model reported at 231,000. So obviously a huge component of the headline number that we're seeing. Very interesting when you consider that ADP is reporting negative 10,000 for their birth death model. More on that later. I'd like to drive home the difference in the data that we're seeing here. So along those lines, let's kind of dive into that birth death model a little bit more. As you can see, out of the overall, leisure and hospitality contributed about 89,000 jobs in the month of May, which is obviously a huge component of the total overall. ADP reporting positive 12,000. So again, stark difference in the data here. And as you can see here, the JOLTS report for the month of April, keep in mind the Bureau of Labor Statistics and the ADP data here is for the month of May, and the JOLTS report is for the month of April, actually came in negative 109,000. So the reason this is significant is because in the month of April for the BLS, they reported a positive gain of 93,000 for leisure and hospitality. That's over 200,000 in difference there between those two figures. So again, stark contrast in the federal government's reporting and the JOLTS reporting. So makes you question which data is trustworthy and which data we should be paying attention to when we're setting monetary policy. Anyways, more on that later. I'd like to dive into a little bit of the Fed meeting, excuse me, that's happening right now, as well as some Fed data that we're going to be getting tomorrow. So again, they are having their press conference right now. The Q&A could potentially be market moving if we were to see any kind of negative answers to some of the questions that Jerome has posed. The thing that's really key to watch out for is the Fed dot plot that's going to be coming out tomorrow. Again, that's an effort in transparency to show where the federal funds rates are going to be cut and or hiked. So that could be very market moving, as it's going to let us know what the Fed is anticipating later on this year and into the next year for rate cuts. So with that being said, I'd like to dive into some good news, because good news is always the best. The CPI, Consumer Price Index report, came out this morning, and it came in lower than expectations. So let's look at that for just a second. As you can see here, the headline month over month increased by only 0.01%, so very low. And that brought the year over year down from 3.4 to 3.27. The headline that you've likely seen in the news is 3.3. The analysts that we follow like to break it out a little bit more, just to give you a little bit more accuracy and precision. And as you'll see, the market will dive into this a little bit further and do the same. So core, as you can see here, up 16 or 0.16, down year over year, 3.41 from 3.6. Let's dive into the core a little bit, because that's going to be important moving forward. So as you can see, shelter, huge component of core, as well as motor vehicle insurance. Like we've been saying, the motor vehicle insurance and shelter components of core are really what's driving the inflation right now. As you can see from everything else, it's decreasing pretty well. So the Fed has gotten prices under control, and inflation under control rather. But as in terms of shelter and motor vehicle insurance, those have been rising rapidly. Although we've actually gotten a negative number this month for motor vehicle insurance. It is down 0.1%. And in comparison to the data that we've been seeing the past few months, I mean, 1.7, 1.8, 1.9, and even into the twos with positive inflation there. So nice to get a little bit of relief, but the shelter component is going to continue to be a bit of a sticker, and we'll go into that a little bit more here in a second. But first, well, actually, let's just go ahead and dive into it right now. So as you guys can see here, this is the shelter and CPI month over month. May came in at 0.54, which helped us out a little bit. As you can see here, though, the numbers keep getting lower and lower, and there are only really 2 high points left to replace. Remember, CPI is a 12-month average, so as we get new numbers in, then we replace old numbers. So this May 2024 number that we got actually over in here, 0.4% is what came out, replaced the May 23 number of 0.54. So that's what gave us a negative inflation growth. So this is good to see. However, keep in mind, as we move forward into this year, we've only got really 2 months left of high numbers to replace. We've got September 2023 here, which is a little high. We could replace that, and we'll give some positive inflation data there. And we could also replace into January of this year. But as we go throughout the rest of the year, we're going to see not very substantial inflation data that's going to help us like we've seen this morning. And just to kind of drive that point home, let's take a look at the charts and see how the markets have reacted to the inflation data we've gotten. So as you can see here, this was Friday when we got that Bureau of Labor Statistics data, sharp decrease in mortgage-backed securities, which obviously led to an increase in rates. Remember, red here is bad for mortgage rates, green is good. So as we came in on Monday, largely sideways in the market, just some anticipation and some jitters, not sure what to expect. Yesterday did very well, or decently well, because of a treasury auction that performed better than expected. And as you can see here this morning, when that CPI data came out, I mean, off to the races, shot up. What was that? Almost a 50 basis point gain in one day. And as you can see here, we're still up 49 basis points. So pretty blockbuster data to get that. And the market is absolutely loving it right now. But as I mentioned, that data that we're going to be replacing is not as high as the data that we just replaced. So we're going to see diminishing returns in the inflation reports. So that brings me to my last point that I want to go over with you guys. And Chad's been driving it home all year, is that to see a real rate cut, we're going to have to see negative job data. So let me go ahead and share the Bureau of Labor Statistics household survey that came out on Friday with the jobs report. Remember, the jobs report says we had a headline gain of 272,000 jobs. The household survey, which is, remember, the Fed calling in to homes across the country and getting their individual input and data from these surveys, says that we lost 408,000 jobs. Guys, that's almost a 700,000 difference. I mean, excuse me for getting a bit flustered here, but something is off. One of these data sets has to be flawed. And, excuse me for assuming, but the one where we actually speak to people across the country versus the one where it's, numbers in the air and possibly cooked numbers, I tend to believe the one where we're actually talking to people. So as you can see here as well, total labor force shrunk by 250,000, and the participation rate as a result shrunk as well. So that has the loss of jobs also infected the unemployment rate, and this is the kind of headline unemployment, U3. This is the one that you see quoted regularly, rose from 3.9% to 4%. Remember, the Fed is expecting 4.1%. They're not expecting unemployment to reach any higher, this U3 level. So if it were to increase over 4.1% to 4.2%, we could see a rate cut. Jerome Powell and 17 out of the 19 Fed members have said that unemployment rising higher than expected could trigger a rate cut. So this is what we're really paying attention to and looking at. And as you can see here, the U6, this factors in more people from the labor force that have potentially left. U3, when these people are considered to have left, maybe they've stopped looking for jobs after about 6 weeks, they've become frustrated. They're no longer counted in this figure. U6, which is probably the more accurate representation of unemployment, does count these figures. And as you can see, it's much higher than 4%. It's actually at 7.4%. Remained unchanged, but still at the highest level that we've seen pretty much since the start of COVID. So that brings me to really the last part here, which is these kind of small signs that you can pay attention to see the strength or the weakness in the labor market. And this is what we're really paying attention to, because as we said, we're really wanting to see a poor labor market to see rate cuts this year. So as you can see, we've lost 625,000 full-time jobs in the month of May. Part-time jobs has risen 286,000, and multiple jobs holders has risen 16,000. You know, I'm no economic expert. I pay attention to these markets pretty well, but this many full-time job losses, that many part-time job increases, and then this many people having to hold multiple jobs to make ends meet does not seem like a strong labor market to me. Yet, of course, as I've shown you with the charts, when those blockbuster headline numbers come out, the markets react poorly to them. They see the headline data and they don't really parse it like we do and peel it apart to see what's really going on. But when you really look at what's going on in the market, we don't have a very strong labor market. We expect unemployment to increase higher than 4.1% to 4.2. And when we see that, we should trigger rate cuts from the Fed. But absolutely, as they've shown, been a little bit unpredictable. They kind of move the goalposts regularly on us. So keep paying attention to their comments, keep paying attention to inflation and jobs data, but stay strong in your job search. If there's any, or in your home search rather, if there's anything we can do for you, any numbers we can run, don't hesitate to give us a call, 312-731-4939. Remember, if you're putting in any offers, we'd love to make sure your listing agent knows how our 3 pre-approval tools work. Or if you have our 4th Cash Plus tool, absolutely would make sure they know how that works. Again, give us a call, 312-731-4939, or email us at chad@thelubengroup.com.